Well, hello, welcome to India Decides, the FII View with me, Tanveer Gill. This is a series that puts the spotlight on India and gets some of the smartest global fund managers to talk about their India outlook, given the global backdrop. Joining me on the show today is Nick Timberlake, who's Global Head of Emerging Market Equities at HSBC Global Asset Management. Nick joins me from London. Nick, great to have you on the show. First up, how has your overall view or weightage on India changed over the last 3 months, particularly as part of your BRIC fund?
Yes, well, thank you for having me. And we like the Indian market. We have not had as much exposure to India as we have today for a number of years now. About 27% of the portfolio is exposed to India. And it's focused on particular sectors, which we can get into if you're interested. It's our second favorite market in a BRIC context. We still marginally prefer China over India.
I know, Nick, you won't comment on politics, but how are you really tying in the risk that there is with the election results slated for mid-May? How are you tying that risk with your India view? What does it mean for your overall portfolio strategy, accommodating the risk that that event brings?
Okay, well, we're not in the business of trying to predict what the Indian election result will be. I think that's a pretty challenging thing to do. There are polls that you can listen to, which paint a picture suggesting that the BJP-led opposition are likely to take power post the elections. But these polls historically have been very unreliable, so we need to bear that in mind. Obviously, the Indian population is a young one. And I'm told that somewhere in the region of 10% of the voters are new voters. So, again, I think there's not a huge amount of data which really supports how those young people will place their votes. So it's early days really to be predicting the outcome of an election. What we would prefer to do is look at the individual companies. The way we think about companies is we're interested in that combination of valuation being low and profitability being high. And if we can find companies with high levels of profitability and low levels of valuation, then we're going to be interested. And there's lots of those in India today. So, if we have a change of government, maybe that will be an additional tailwind, icing on the cake, but that's not really how we've set our portfolios up to expect that outcome.
Right, but from a value perspective, FIIs traditionally see India entering a bit of an expensive zone at 15 times one-year forward earning. Right now, we are, post this rally, we are roughly at about 14 times the FI 15 earnings. What is your view on India post the recent run-up that you've seen from a valuation standpoint and the potential upside that you see for the market from here?
Okay, I think that's a fair question. The Indian market, as you say, is approaching the 10-year average valuation level, which is about 15 times earnings. So on the face of it, the market doesn't look extremely cheap. And I've been saying that we like investing in companies that are extremely cheap. But I think what you find in India is actually what you find in many other emerging markets today, which is extraordinary polarization in the market. So you've got a group of companies which are very expensive relative to their history. And then there's another group of companies which still remain really quite cheap relative to their history. And they can be split in the broadest of terms into the categories of cyclical and defensives. And what we're talking about on the one side and the other is on the defensive side, and these are the expensive ones: healthcare companies, IT services companies, to a degree, telcos, and consumer staples. So those companies we tend not to have a huge amount of exposure to. And I think the valuation argument there is a tough one. On the other side, there are large chunks of the Indian market. We're talking about financials, materials companies, industrials companies, energy companies, which are trading still a long way below their historical averages. So it's interesting to look at the overall valuation in the market, but I think you need to dig deeper to really kind of sift through where you want to be invested.
Nick, a large part of the returns for foreign investors also depends on the way the currency moves. So, are you seeing more upside for the rupee from these levels? What's the view on the currency?
So the rupee is a difficult one. Obviously the rupee has depreciated really very substantially over the last 12 months. It was this time last year, I think the rupee was somewhere around about 54 to the dollar. You know, at the height of uncertainty last summer, when the Fed started tapering QE, we saw the rupee really collapse down to the high 60s, and now it's, as you say, there has been some recent strength. It's rebounded to about 61. So I think, you know, there are some benefits to the Indian economy from the depreciation. In fact, there's been a depreciation of the rupee over the last 12 months, and that can really be seen in the reduction in imports, some pickup in exports, a much improved current account picture. I think at the worst, last year the current account deficit was around 6%. Today, closer to 1%. That makes India much less needing of foreign capital, and in a way more insulated from what's going on in the outside world. So I can see arguments for the authorities really not wanting the rupee to dramatically appreciate from here. And our central case scenario would be that the rupee stays in a range around the current levels, maybe 5% up or down from here.
Return expectations on that specific point, you know, what are the return expectations that you're working with for India? Is a 15% earnings growth plus 2-3% upside coming in from the currency a fair estimate? That is roughly about 15 to 20% return from the Indian market. Do you think that's realistic given what we've done so far into the year, or too optimistic?
It's very difficult to predict, you know, what the returns from an individual market will be. I agree that earnings is one factor that we need to consider, and we've discussed the movement in the currency. We're obviously thinking about returns in dollar terms, and so that we can compare from one market to another. Looking at that earnings forecast, to a degree it does assume that we don't see a substantial appreciation in the currency. There are a number of companies benefiting from the weaker currency. So bearing in mind our currency view, we think mid to high teens earnings growth this year is possible, and that should certainly be a tailwind for the market. I wouldn't like to be drawn on exactly what the return for the market will be, though.
Among sectors, Nick, which sectors do you like the most at this point, and where are you overweight in the Indian market?
In the energy space, in the materials space, in certain financial companies, there remains really very attractive value. And in the last month or so, we've started to see some of that value really being captured by the market, and those share prices moving up really quite strongly. And then on the other side of the equation, it's much more difficult to find value in the IT services space. There are pockets of value in IT services, but I would say the vast majority of those big IT services companies, to us anyway, don't look like they offer great value. In the consumer staples and healthcare space, it's also really challenging to find decent investment opportunities today.
Now, IT and pharma have done well. Do you have exposure in those sectors, or are you looking for opportunities in the cyclicals? Have you altered your India portfolio sector-wise over the last 3 months?
We have been exposed to the IT services area. We've been able to take profits there. We've been able to recycle some of that money into the sectors that I mentioned previously that we really like in the energy space, certain industrial names and certain financial names.
Right, Nick, there's a lot of talk in India about value in state-run companies. Actually, it's a bit of a debate, so, you know, opinion is divided on that front. But, you know, what's your view as far as value in state-run companies is concerned, you know, value in state-run banks? Also, on the other side, you've seen a good trading rally in cap goods, autos, auto ancillaries, some of the infrastructure companies. So where is it that you're spotting value, adjusting for growth potential in some of these sectors?
So I'd agree. I think that, you know, those are the kinds of companies that I was alluding to. You have to be careful about which company you pick, and you know, we tend not to talk about individual companies in these kinds of sessions. So sorry for that, but I think those sectors that you mentioned, you can find there are lots of opportunities in all of those sectors.
Let's talk about you know, emerging markets and the world at large. Let me first begin by asking you about what you made of the FOMC's decision and the timeline that they've laid for rate hikes going forward. Also, the impact that the markets are likely to see in lieu of the continuing tapering that's going on right now, and possible rate hikes that may happen early next year.
Obviously, Fed policy is key in setting the tone for markets. And I think the immediate reaction was that maybe a slightly more hawkish message, maybe interest rate rises are a little nearer by than some investors thought. Our central case scenario is that we won't see rates going up in the US, certainly not this year.
Now, emerging markets have underperformed developed markets, so far into the year. When do you see risk appetite returning to emerging markets? Are you already seeing that happen right now in the recent rally, or do you think there's going to be some more time before allocations, start tilting towards emerging markets in a meaningful manner?
So it's a difficult question to answer, that one. I think there are a number of headwinds for the emerging markets, and you touched in your first question on Fed policy and obviously the QE tapering, as that is ongoing, is a headwind for the asset class. There's no doubt about that. There are a number of other headwinds, and I think really depending on how those issues play out, we'll have to wait and see when emerging markets might start to do better than developed markets. It's not all bad news from an emerging markets point of view. I mean, if you look at the valuations, they are very close now to the extreme low levels that we've seen in previous major crises. The asset class as a whole is trading on just 1.3 times book value, which leaves it really 10% from all-time lows. I think it's also fair to say that there's been a huge amount of money exit the asset class over the last year or so. And again, that historically has been a sign when the money has gone that the markets start to find a floor, and things start to improve. And this year alone, we've seen somewhere in the region of $37 billion flow out of dedicated funds across the asset class.
I also wanted your perspective on the whole EM export story. EM exporters are being favored by investors for a while now. The other side of the story is, of course, how import demand builds in Europe and the US, how that shapes up. What will be the key drivers for the export story in emerging markets, given the recovery that we're seeing in the developed world?
Yeah, I mean, exports obviously is a key part of the overall picture. And what with the US economy now starting to show really quite a strong recovery, we're thinking that the US economy will grow somewhere in the region of 2.7, 2.8%. In 2014. The European economy is also showing signs of recovery, obviously from a much lower base. Last year, Europe as a whole contracted marginally. This year, we see 1% growth. There are bright spots within Europe. Here in the UK, maybe the growth is going to be at a similar level to that of the US. And that will create more demand for goods and services from the emerging world. So that, I would say, is a positive. I think it's also fair to say that more and more these days, exports from the emerging world go to the emerging world. Again, that's a structural change that's taking place and I think should help to support the export picture. And then finally, if you look at exchange rates across the emerging world, many currencies have fallen over the last 12 months or so. And again, will only help to stimulate export activity.
While the demand from the US seems steady, how are you mapping recovery in Europe? Because that's also a key market for EM exports.
Yeah, obviously the recovery in Europe is on a slightly different trajectory to that in the US. It's taken longer to come through. It's today, so far, much more subdued. There are some bright spots that I mentioned. There is, the whole issue of the current crisis in the Ukraine, and exactly what the Western world's response will be to that. And it's difficult to imagine any sanctions that have teeth not resulting in some additional headwinds for Europe. So we need to watch the European situation carefully.
Right. Global growth is expected, Nick, to be around 3.5% for this calendar year. How much of that would come from EM exports, you think?
Okay, so look, I don't have a precise answer for you on that. I can tell you that emerging markets today represent roughly half of global GDP, that within emerging markets GDP, roughly a quarter of emerging markets GDP is export related. So from that you can infer that somewhere in the region of 10 to 13% of global GDP is emerging markets exports. It's a factor in driving that 3.5% growth. I can't give you a precise number in terms of what percentage it is.
What about domestic growth potential for emerging markets? Because that's really mainstay, especially for a consumer-oriented economy like India and China moving towards that model. When do you see a structural recovery on that front?
So I think, the domestic growth is a growing and more important part of the emerging market story. I'd say it's, maybe there's more cyclical concern there, but structurally what we've seen is domestic consumption and domestic growth slowly but surely becoming more and more important as the people living in the different countries in the emerging world have become more wealthy in recent years. If you look at a country like China, China's now overtaken the US in terms of demand for cars, for instance. It's now the largest market in the world for cars. So that's just one example of the importance of the emerging world in driving consumption from a domestic perspective.
So broadly speaking, which are the markets that you're overweight or underweight on respectively within the EM world? And also, where is incremental capital being allocated?
So in terms of our views, if you look at incremental capital, where most of it's been going is not necessarily ties in with our views. But our views today, we would suggest that investors look very closely at the Chinese market. It's a market that's generally unloved. It is offering really extremely attractive valuations. And there are lots of interesting companies that one can invest in there. And the other market, of course, is India.
In terms of interest, are you seeing more money come into your EM dedicated funds over the last 3 months? Is confidence building or waning in emerging markets in the eyes of investors?
I think confidence is very low, and that's, normally that's a good sign. When confidence is very high and everybody's buying, it's usually too late. So, you want to be a bit contrarian, I think, when you're looking at what other investors are doing and do, to a degree, the opposite. Maybe not immediately, but we're now, we've been seeing outflows from the asset class really through most of 2013 and accelerating into 2014. We're at a point which is pretty extreme in terms of the negative sentiment, and that gives me some confidence that maybe not this week or next week, but certainly in the coming months, we'll see some stabilization, and given where the valuations are now, I'd say that this isn't a bad entry point at all.
Right. Nick, how big is the China concern for commodities and your overall EM view? The market is cheap and has priced in most of the slowdown. That's one view on China. But how are you looking at the story?
Yes, no one is really sure how the growth picture will pan out in China. I would say investors generally are taking a very cautious view today. There are a number of headwinds for the Chinese authorities. They're trying to push through tough reforms. Many of those reforms will, as a short-term side effect, create some pressure on growth. There has been a very substantial pickup in debt levels in the Chinese economy, really since the global financial crisis in 2008. And investors worry that that may also put some brakes on China's ability to keep the growth coming through. And then obviously we all know about the pollution issues. Anyone who travels to China is fully aware of those issues. And again, to tackle many of those issues may mean that the sustainable levels of growth can't be as fast in the future as they have been in the past. And China today is the world's second largest economy and is the marginal buyer of most commodities and therefore the price setter of those commodities. And so if you have that view that I just took you through, some of those cautious views, it's difficult to be overly positive on the outlook for individual commodity prices.
And what's the outlook on metals and commodities? Does the sentiment remain subdued and thereby avoid metal stocks?
So the way we think about things is we try not to take too much of a view on what direction the price of X or Y commodity is going in. What we're much more interested to do is to take an individual company and stress test that company's profits for different scenarios of commodity prices. And where we see that that company has an attractive risk-reward profile, then we may choose to invest in that business. I think it's a very tough game to be calling the short-term direction of these commodity prices. There are so many factors which can influence them, and it's not an easy way to make money.
Right. What, to your mind, right now are 3 key risks for emerging markets at this point? Do you think that the worst is behind for emerging markets, from a macro perspective?
So look, the key risks are, they've been mostly anyway around for some time now. I'd say, liquidity, and by liquidity I'm talking about the general level of monetary policy in the world is a key driver of the direction of the emerging markets. And obviously with quantitative easing, slowly tapering, taking liquidity out of the market, that can prove and has proven to be a headwind for the asset class, and that is ongoing. The Japanese are now talking about maybe extending their QE program and being much more aggressive than they have been in the past. So we need to watch that situation very carefully. I'd say that is a key risk. China, we've obviously spent some time already discussing that this afternoon, and it seems to me that China remains a risk. There's a lot of uncertainty about exactly how fast that economy will grow through the rest of this year and beyond. And if there is a sharp slowdown there, that wouldn't be our central case scenario, but if there is a sharp slowdown there, that would be a significant worry for the asset class as a whole. And the third one, which is geopolitical, and that's a pretty broad statement to make. There are lots of crises around the world. I guess the one that's foremost in our minds today is the situation in the Ukraine and the annexing of the Crimea by the Russians. There is, I would say, a huge amount of risk surrounding that situation. It could easily spiral out of control, and so we need to watch that very carefully as well.
So what is your broad EM strategy? Buy at every dip, as we just saw, the market rebounding from February lows, or book profits, take money off the table at every rise? That is, the current rally that we're seeing in the markets.
Look, we're dedicated investors, so we're invested. We're not trying to move out of the markets into cash or into some other asset class and then back in again. But for those people that maybe are thinking more in terms of different options beyond emerging markets, I would say looking at history and considering the valuations that we see in the asset class today. I mentioned some numbers already about 1.3 times book value. This is very close to trough valuations. Historically, investing at this kind of level of valuation has been rewarded with profits. Maybe not immediately, it's very difficult to pinpoint the exact timings, but certainly over the next 12 months I would expect investors to be making money if history is any guide to go on from this level of valuation.
And finally, Nick, as a fund manager, are you fully deployed as part of your investments, or do you have higher cash levels, perhaps allocations to gold as a hedge?
So look, as I mentioned, we tend to be fully invested. We're dedicated investors. So from our perspective, we're not going to be kind of moving into cash or gold to try and hedge our positions. We're just trying to find the best and most interesting companies across the emerging markets. And we have a large number to choose from. There's over 1,000 companies that are large and liquid that we could invest in.
All right, Nick, we leave it at that. Thanks very much for speaking with us and giving us your perspective on India and emerging markets. With that, we come to the end of this edition of India Decides, the FII View. Catch you with another special guest next week. Till then, take care.